Hi, hockey family. Tyson Strachan here, joined by my former D partner from college, Johan Kroll. Today we're going to dig into a webinar talking about NHL deferred contracts, just taking an objective look at them. Obviously, they've become more of a hot topic as of late, and it's just something that came up in conversation kind of more and more. We've kind of had the similar questions keep coming from both players and agents about these. Enough so that we felt like it was worth taking a deep dive into. So Johan did a lot of research on this and put together our most recent quarterly newsletter that we're going to mail out later this week that really kind of digs into this. But we wanted to accompany that with a webinar, and here we are, right?
Yeah, some people don't like reading. It's some people like watching a video instead. So figured, yeah, and like Strax, pointed out, like this wasn't something we were planning on doing a bunch of work on, and then we started getting more and more questions here in the office on the topic, and so I thought it was worth investing the time into, kind of understanding what was happening, why these deals were being, more of them were being brought to the table over the last year, and came across some nice little pieces that we'd like to touch on today. So we're going to start with just the basics, just ensuring everyone understands like what are deferred compensation contracts. And after that, there's a reason why NHL teams are currently pushing for this structure, right? It's not a random coincidence why we've all of a sudden had some of these come up in the last year. So we're going to talk about why. We will also discuss potential tax benefits for players. We'll look at some other risks for players that choose to enter a deferred compensation arrangement. And then lastly, should a player decide to move forward with a deferred compensation contract, there's some wealth management adjustments that should almost certainly be made.
Yeah.
Before we dig into that, the lawyers always like me to mention, we're going to be going over some material today, and our team here at Hockey Wealth, yeah, everything we're putting together here, this is for educational purposes only. We want people to have a better understanding of what's going on. But by no means, anything that we're going to touch on here in the next little bit, none of that is meant to be, considered financial tax or legal advice. All right, Strax,
Exactly.
kick us off.
Yeah. Yeah. So I think the first thing to kind of point out is that we have heard kind of from multiple sources that these deferred contracts aren't something that the NHL itself loves. So going into their collective bargaining that they're doing, right now should be kind of agreed upon within, let's say
Next,
just the
yeah,
next
a little bit here.
year and a bit.
Hmm.
So um, these might not even be an option, come 2 years from now. So it might be kind of a moot point, but obviously it is something that is being discussed a lot right now. So I think it's worth going into. Obviously, we saw the Seth Jarvis deal kind of start things off, the Slavin, McCabe, all kind of similar. But then the Frank Vatrano deferred contract, very extreme, I guess, from the way that it
Hmm.
is, structured. So Johan did a really nice job kind of digging through that, and we're going to use that as the example today.
Yeah, it's just a nice example of what's actually happening here, right? So the contract headline comes across, 3 by 6 for 18 million total value. But then you start looking at the details and why it started gaining all these headlines because, Frank isn't receiving all 18 million in the term of the contract, right? And not in those 3 years. Okay. Rather, like the way this contract is structured, only half of it is being paid in the actual 3 years of the performance of the hockey contract, right? So it's rather than 6 million a year. Again, he's just collecting half. So Frank's receiving $3 million a year in year 1, 2, and 3, and then the remaining half of the contract, the last 9 million of the deal, you'll see it's not collect. It doesn't even begin to be paid until the year 2035. All right, at which, in 2035, it starts a 10-year income stream of $900,000 a year, which won't be completed until 2044. So really, the contract won't be paid in full for almost 20 years. Okay, so this is just kind of the extreme nature of the deferred compensation contract for Frank Vatrano. And again, like Strax mentioned, when the Seth Jarvis deal and Slavin and McCabe came out, like, those deals, the deferred comp pays like the year right away, the year following contract expiration. So this is just a pretty extreme case of the use of deferred compensation. And so we thought, a good example to kind of talk about, because we think more NHL teams are going to push for these in the coming year here.
Yeah. And so you're going to look at kind of why more NHL teams, why we think they're going to be pushing for these.
Yeah, exactly. And what this comes down to is what's called the implied discount rate. All right. And so in short, as we'll discuss here in a minute, the higher the interest rate environment, the more incentive NHL teams have to negotiate deferred compensation into contracts. Okay, and the way this implied discount rate works, so this is right out of the CBA. If you're kind of nerdy like me, you want to look at it. It's Article 50, Section 2A, and it states the way these deferred compensation contracts work, and the way they're discounted to get to a present value. But right there, it says like the discount rate to be used. Originally, it was 1 year LIBOR plus 1.25, so 125 basis points. Now, LIBOR has since been discontinued a couple years ago, so the SOFR rate, SOFR lending rate, has kind of replaced that, but it basically does the same thing. And so the way this works, and why interest rates are so important as it pertains to deferred comp. Okay, so in Frank Vatrano's case, so going back, again, years 1 through 3, he collects half of the contract. Okay, and so in terms of calculating the present value of this contract, as long as the compensation is received in the actual years of the, so years 1, 2, 3, this first 9 million doesn't receive any kind of discount. The team does not benefit from the discount rate whatsoever. However, in these last 10 years, okay, these last 10 years between the 2035 and the 2044 payments, the implied discount rate at the time of Frank Vatrano's signing was 5.41%. All right, so 5.41%. And one important point I want to point out before I forget. So this discount rate, this implied discount rate, this gets locked for the entire payment structure at the time the SPC is registered. Okay, so in other words, like the Ducks get the Ducks get to use this 5.41% discount rate for the entire, call this almost 20 years of the payment structure. Right. And so why that's important is, while the first 9 million that counts against the cap right away. Okay, that's 3 million a year, right, in calculated cap space. But each of these years, each of these cash flows that are 10 years in the future, every one of these cash flows needs to get discounted back to a present value. Right. So they're going to discount each of these cash flows 5.41% to get the present value of the contract. Right. And so to show why that's so important, right? So if you take the present value of the second half of this contract, right? So even though Frank's receiving 9 million, it's actually only worth 4.71 million after being discounted by this implied discount rate. All right. And so you run the math, right? So we have 9 million that's received right away here. And the second half of the contract is actually only worth 4.71 million because there's such a high implied discount rate, right? So 9 million plus the 4.71 million, this gives us an actual present value contract of 13.71. We're going to divide that by the 3 years of the contract. And this is where the league gets their average annual value for Frank's contract. of 4.57 million AAV for the contract. So obviously, what this tells us that the Ducks weren't willing to pay, $6 million worth of cap space. In their eyes, they thought, they could save some cap room by structuring this deferred comp arrangement with Vatrano and his representation, and so that's where the Ducks are able to save a lot, a decent cap space here through a higher interest rate, this implied discount rate. Another really important point here, and this is just a little financial, it's a little nerdy, but worth pointing out. The longer the deferral, that is also going to create a deeper discount to present value, meaning that will also lower the average annual value. All right, so NHL teams have tremendous incentive when we're in a higher interest rate environment, and it helps also the further that they can push out when those cash flows are received. That's going to discount the AAV even further. Okay, so just to show another example of just why interest rates matter so much, and probably why you weren't hearing about deferred comp much when we're in a COVID pandemic and interest rates are low, and then all of a sudden we're in this higher interest rate environment, and now you see these deals popping up more. I'm going to show. So here's Vatrano's contract structure again: 9 million the first 3 years. Like we just showed on the previous slide, implied discount rate 5.41%. This is the calculation we just did. At a 5.41 discount rate, we have an average annual value of 4.57 million. Okay, so the only thing I want to change, just to make the point, again, let's say rather than the implied rate of 5%, let's use a 1.25%. So a very low interest rate environment. Like this would be similar to like the COVID pandemic. So all else being equal, the $3 million the first 3 years, and then we have the remaining $9 million over years, call it 10 to 20. Okay, so that's the only change is this implied discount rate, and so we have 9 million up front, and then you'll notice in a lower interest rate environment, the present value does not get discounted nearly as much. So if we're using 1.25, 9 million. That the second 9 million is only discounted down to 7.71 million, meaning the present value in a lower interest rate environment like Vatrano's deal, it would actually be worth 16.71 million. Okay, you divide that by 3 years, and just purely a different interest rate environment would the cap space that Vatrano's deal would take up would be closer to 5.57 million. So in other words, a full extra million of cap space that just a different interest rate environment would create.
It's important to kind of point out too, is we're talking about $1 million of cap space just on a 3x6 contract. Imagine applying this kind of structure to, a franchise player, right? Like a max 8-year by 10, 13 with this type of deferral. Pretty amazing what you could create.
Yeah, it really is. So that's why teams want to do it, right? It's you can potentially create you can save a lot of cap space in a higher interest rate environment. So that's the motivation for teams. Now, on the player's side, are there potential tax benefits? Yeah, without question, for Frank Vatrano, like this was almost certainly his primary motivation. All right, so Anaheim, of course, is in California. California, as some of you know, and if I read correctly, they have this new uncapped payroll tax where now it looks like the top marginal tax rate is up to 14.4%. And I don't want to get any nasty emails from CPAs, accountants that are watching this, because what I'm about to show is obviously an oversimplification from a tax standpoint, but it's not crazy to think, just doing very, very rough math, right? So rather than Frank, collecting all 18 million, right? So if he's only collecting the 9 million in California and deferring, 9 million to later years, it just very rough math. It isn't crazy to think that Frank could potentially save, over $1 million in California state income tax. That's 14.4% of 9 million. Obviously that's more than $1 million, but I feel like it's a fairly conservative estimate where uh, Frank could potentially save $1 million by not paying as much to the California state income tax. Okay, now in order for that, again, potential tax strategy to work, Frank would need to, once he collects these deferrals down the road, he'd have to live in some kind of lower income tax state, such as Florida. There are a handful of lower income tax states.
And so obviously going through that, last slide, you see kind of the incentive and the potential of the tax savings, but what do you kind of see as the biggest risks of this, taking on one of these?
A couple risks, absolutely, Strax. So the one is like legislative, and we've already seen this actually on a much larger scale. All right, so some of you might be familiar with baseball star Otani. He pitches, he hits home runs, he's pretty incredible. And so he has a deferred compensation contract with the Dodgers on a much larger scale. All right, so I looked it up before I came on the call here. So he signed a $700 million contract, of which 680 million is deferred comp. So he's just receiving a couple million a year and then deferring $680 million, about the same time that Vatrano is going to start collecting his. I think Otani starts in 2034. But not surprisingly, the California legislators don't love this, and they're already pursuing legislative action um, against this arrangement. Okay, so in their eyes, and we'll see what comes of it, but like in their eyes, they've stated, that they want to close this loophole where not just athletes, but also corporate executives, like they feel if you are living in California while you're earning your income, you should be paying their state income tax. So that there's certainly like a legislative risk. We'll see the way that plays out. Me personally, I think the risk least discussed that maybe should be is just the uncertainty of future taxation. Okay, so future taxation, and I mean even more on like the federal side. Okay, because I think we've all seen, that there are concerns here in the States about the federal debt. I think it's 36 trillion, something like that, these days. As it stands today, the current, marginal, the top tax rate for in the U.S. you called 37%. All right, like it isn't crazy to think that 10 years from now, that top federal tax rate could be 50%. Obviously, a lot that would depend on, who happens to be in the Oval Office in the years ahead, and the makeup of Congress. But like, many times in America's history, we've had tax rates north of 50%. Right. And so just given the federal debt levels, we'll see. But I think it's a very real risk if you're deferring compensation today and hoping to save some money on California state income tax, for example, like that there's no guarantee the federal rate's still going to be 37 in the future, right? So if the federal rate's 50 and your income falls in that bucket, any savings that you might have had on the state side, you could unfortunately you might lose it on the federal side if things don't work out. So also kind of something to consider in that regard.
Obviously, there's also a ton of inflation risk, right? Just considering how much purchasing power, that deferred 9 million is going to have down the road. Obviously, inflation been a big topic as of late. We look at the simple stuff like how much eggs are costing, or you could go bigger and think about, what a house is going to cost at that time. If you're assuming going to Florida, if it's moving to Miami, what's the cost of living at that time? So there's definitely some opportunity cost there that's being risked.
Yeah, inflation, and we've seen the simulations, right? So if you don't know what purchasing power things are going to have 10, 20 years from now, right? So if you run a simulation where inflation stays within kind of that 2 to 3% target that the Fed likes, in Vatrano's case, Frank's, he'll be that 9 million will probably go a pretty long ways still. But if somewhere in these years, we get multiple years of inflation above target, it can have some devastating effects in terms of what that money is going to be worth in the future.
Yeah, and obviously we also want to discuss the opportunity costs, and I kind of jumped ahead there before, but and critical wealth management adjustments that we think you need to be considered if you're deferring salary like this.
Yeah, exactly. So you notice what I put on the screen here now. Like I'm completely ignoring that first 9 million that's collected the first 3 years, right? So we're just solely focusing on the deferred comp portion of a contract. Okay, and again, just using that discounted value of the last 9 million. Okay, kind of like we shared in the previous slide. One way to kind of look at this, and from a wealth management perspective, would be uh, again that the present value of those future cash flows. So the present value today, so the deferred comp, it's kind of like putting in a $4.71 million investment like today. All right, and that investment, the deferred comp, right? It's going to end up paying the 9 million over these 10 years. And so if you think about it, like deferred comp acts almost exactly like a bond investment, right? It's you have the present value going in today, and then you have these coupons that are being paid for 10 years in the future. Okay. Very specific to Frank Vetrano's contract, like these coupons, again, it's just we're kind of doing the opposite. If we're discounting the 9 million to today's present value, you can kind of think of it as this is like a bond investment that is earning a pre-tax return of 5.41% over the next 20-ish years. The 5.41%, that's comparable. A number of kind of fixed income investments. And so, kind of the question and criticism that has been raised by a number of sources. You know, can that other investments, over a 20-year period earn higher than 5.41 annualized return straps?
Yeah, of course they can. Uh, but just to be fair, I mean, there have been multiple 10-year periods where the US market has produced negative returns. So there is obviously risk. It's not a guaranteed thing. I show here that in most scenarios, it probably could, correct?
Yeah, it could. So Frank, would he be better off receiving? Yeah, in other words, would Frank be better off accepting a smaller, so not the 18 million, but as the AAV suggests, right? If it's more of a $13.71 million contract, right? So instead of deferring out this 9 million, hey, just collect the whole thing, in the first 3 years, and therefore, you have this extra 4.71 million. Would he be better off having those funds today, where then there's the opportunity cost. He could invest those in a number of different asset classes that might be able to earn 8 to 10% returns over the long run? Yes, yes. But as Strax correctly also mentioned, it's not guaranteed, right? So therefore, we would say, while deferred compensation from an investment standpoint, it's likely suboptimal in most scenarios. I would say probably 99% of scenarios, it's likely suboptimal over a 20-year period. Um, it may be a conservative alternative for a player who would prefer to mitigate some market risk.
And then obviously we think it would be a big mistake, right? Like you said, this is just like having, a large bond investment, right? So you'd want to make changes to, how your current allocations are set up, correctly?
Yeah, exactly. So again, should a player and their agent decide, hey, that this structure, might be worth pursuing, you would almost certainly want to make wealth management adjustments to the existing portfolio, right? Because um, again, this is a bond. Deferred comp is a bond, and so if the rest of the portfolio is primarily bonds or other fixed assets, you'd be opening yourself up to significant inflation risk. So if moving forward in an extreme example like this, it would almost certainly be prudent and wise for a player to just tilt the existing portfolio a little bit more toward some longer term growth assets.
Makes sense to own a bunch more bonds when you already have a big bond.
Yeah, exactly. So in summary, we think until the NHL squashes it, maybe in the next CBA, given the current interest rate environment, we expect more GMs, more management will continue to push for deferred compensation contracts. If players and agents are willing to entertain the idea that they should negotiate for more nominal dollars and/or longer contract duration to compensate for the additional risks that we discussed. Players may potentially be able to reduce taxes, but just keep in mind that that strategy also involves some risk that we touched on. While accepting deferred comp is likely suboptimal from an investment standpoint, it may be a conservative alternative for a player who would just want to mitigate some market risk. And then lastly, like we just touched on, should a player accept deferred compensation, wealth management adjustments should almost certainly be made to the existing portfolio to fight inflation.
And just in those conversations we've been having, it's kind of interesting to see the wide variety of kind of how different agents and players have looked at these and not looked at all of those different things. So I think you did a great job digging through that. Obviously, best case scenario of thinking this to be fair are more of the contracts that, if you're thinking of a player going into his last contract, keeping that deferral period shortened, right? Not introducing that long period because it's just more and more risk that's coming in there.
Yes, I would, and I think you need to be really, really careful any deferral longer than a year. But I think you almost certainly, just in my opinion, I realize people might feel otherwise, but just I would want to keep it shorter than 5 years, right? At the most, just because, yeah, if you keep it shorter, right, that then you're just going to have the highest probability of tax strategies working. Like again, moving from California to Florida. Also, you're reducing the inflation risk, right? If we're looking at inflation over a 5-year period, inflation is just exceedingly difficult to forecast. But a 5-year period, you might have a better chance than a 20-year period for keeping like a really bad sequence of inflation out of play.
Yeah, well, I think you did an awesome job digging through this.
That is all right. But
If anybody else has any questions, right? So they should reach out.
yeah, questions, comments, concerns. We love being a resource to the hockey family, whether it's players, agents, families. We'd love to hear from you.
And they should keep an eye out for the newsletter that'll be coming.
Yeah, that's coming later this week. I think we're
Yeah,
mailing it
we're
out
gonna
here.
get it
But
in the mail, so everybody should have
yep,
it within the next couple of weeks.
awesome. Appreciate you taking the time, guys.